It's a funny old world, is it not? Well, speaking of which, let's look at the mixed picture on crude prices, or at least it was a mixed end on Monday. So you still got those implications for refineries and the broader market from recent hurricane activity in North America. The number of oil rigs operating in the US at its lowest level since June in the last week. And we have seen NYMEX light sweet rising 2 cents and going a bit further beyond that mark, but still not managing really to show much in the way of upside above 50. I mean, you can see there a minor breach of it, but this seems to be the imponderable. How do you sustain a rally above that level? Well, Pete McGuire from XM.com live out of our City CBD studio. Pete, welcome to you. That is the kind of magic number, but unfortunately there's nothing masterful about failing to get there and hold above there. So what will it take?
Well, good afternoon, Carson. I think a couple of things. First off, if you look at that $50 magic number, yeah, it's had a very nice uptick and a really nice momentum from around that $46, $47 price. And that's been all on the back of hurricanes. And, of course, Brent, $5.50 premium. That's a very, very wide spread when you think about that number. So they're probably a little bit further momentum, but I think the jury's out this week. If that other hurricane comes through, Maria, and it causes problems, then that could really affect the market. But at the present time, I think it's going to just stay at these sort of levels.
Refineries out of North America, you know, those that have knocked offline, not least of all the Hurricane Harvey connection. Yep. When should we see some more normal operating performance kick in, would you say?
Well, that started the better part of mid-last week, and it'll continue to ratchet up over the coming weeks if you don't see any further outages. Also, this time of year, you see those maintenance programs come into play, and it's not unusual to see, you know, a pullback as far as those refineries. So I think that that traditional, the fall season is really the time as far as maintenance and those other factors come into the market. So I think pretty much you're going to see that consolidation, and you probably necessarily, from a refinery part, you'll see a little bit of an uptick come the latter part of September, early October.
Okay.
Peter, it's John Milroy from Albernet here. Just quick on some of that disruption would we certainly welcome, you would have thought, given some of the price action that it might result in some disrupted or less production as well, and less supply into the market.
Well, exactly right, John. And, you know, when you look at the Saudis, they're curbing their production numbers and their exporting numbers. I think they're down to 3-year lows, and that's quite simply because of that global overhang. Yep. So, you know, the OPEC producers, all of them are pulling it back. The other side, of course, is weather outages and maintenance this time of year. But really, that point I made earlier, that $5.50 spread, Brent versus WTI, the North Sea production, they're cutting those back. Their maintenance levels on that as well, and then more imports coming into Asia. So that's really pushing the Brent market up, and that spread versus WTI, John.
Let's engage in a bit of hazing, shall we, over bullion. Things are looking decidedly unclear, shall we say, net about directionally where things go next. Geopolitics on the one hand, you know, tightening by the Fed on the other. US dollar? Yeah. Quite.
Exactly. Well, in the last 10 days, Carson, you're down around about $53. It was a really strong push up there to, you know, that 1365 number. Now she's sitting at 1311. If the jury, if Yellen says we're going to see a rate rise this year, then I think, and that, say, you know, December, if those comments come out over the next couple of days, then I think you're going to see a 1250 handle. If you don't see a rate rise, it's probably 1350. Look where the US dollar plays. Have a look at, we've also got that undercurrent there as far as geopolitics, and that doesn't seem to have gone away anytime soon as far as North Korea. So all of those ingredients going into the mix, it's going to be a wild oscillate between that, you know, those two numbers. And great for a trader's perspective. If they get on that and they're on a momentum trade, they can do very nicely out of it.
Because we saw a 13% surge in less than 3 months, which seems really kind of unsustainable. Was that too soon, too fast?
Well, I think a couple of things played into that. First off, the geopolitics. Secondly, the US dollar falling. Nothing concisive coming out of the Fed. Draghi and his mob, you know, ratcheting up as far as quantitative easing. So that really all worked into that sort of, you know, powder keg environment to push crude higher, push gold higher. And now we have just seen a little bit of profit taking off $50. Look, it's a wait and see. But this FOMC meeting this week really is the judgment day, and let's just see what Yellen's prepared to do.
Okay, the iron ore market is dropping to near a bear market now. What are we saying is going to stop this one in its tracks? Because it looks as if there's this imbalance going on between certainly the Chinese domestic output meeting what is a runaway pipeline on production and delivery.
Well, exactly right. You know, and then you look at all of the base metals. They've had, you know, a little bit of a correction over the last few days. They've had very strong upticks, iron ore being one of them. You look at the copper market, that's up about 45% year on year. So, you know, all of those markets have had very, very strong moves to the upside, and they're coming back. You know, the volatility with them. And that's right, exactly. When they look at the Chinese demand picture and steel producers, you can't get away from your mind's eye as far as those warehouses and stockpiles were at record levels. So it gets to a point that, you know, that's got to work through a market. And it's probably at the present time they bought strategically well, but the price went up, you know, and it did very, very nicely for the miners. And there's just a little bit of price consolidation. Hard to put a forecast where you think, you know, iron ore is going to be. If you put it over a 5-year or 10-year graph, and it'd send you to the nut house. So, well, it's just volatile, and that seems to be the way of the market.
What about a 2-day forecast for where the greenback will be after the Fed?
Gee, well, if Yellen doesn't say go, then I think the US dollar is going to take some pressure to the downside. US dollar index will run about 90, 90 and a half. If she does do something, then it is going to force the US dollar up. It'll force our dollar down. You might go up half a cent to a cent for the US dollar. And what's it going to do to equities as well. So keep a very close eye on it. It's going to be a great time to trade, and many traders are strapping themselves in for that, you know, wild ride. And everyone's sitting there, from crude to gold producers globally, and the Asians are looking at it as far as their time zone, of course, the Aussie US dollar trade.
And a final thought on softs. What's your top pick in the ag space?
Well, I think if you're looking there, you've got to keep a very close eye as far as, you know, the grain production. I'm worried about wheat. I'm worried about certainly the rain and what's happened here. I think it's only going to be onward and upwards, and we've had a very, very strong, you know, downward pressure, and that could really affect the grain production globally. So I think there's more upside for that particular market in the short to medium term.
You'd have to say that would be inflationary.
You would say it, but also the other side, Mother Nature's been very, very evil to all the Aussie, the farmers over that dry winter conditions, and I think that there's further upside there. Demand's looking relatively strong, and if you don't get any rain, it's going to be a very harsh crop production for the Aussies.
All right. Watch out, GrainCorp and friends. Right.
Exactly. Okay.
Thank you so much, Pete, as always.
Thank you, Carson.
Talking on, Pete McGuire from XM.com. They're live out of our Sydney CBD studio. You got a view on all of that, John?
On the softs?
Yeah, particularly just on an equity play relationship. You know, the likes of a GrainCorp and Elders. You know, do you sort of swim in that space at all, ag-wise?
I don't really for clients, Carson. Certainly, our ag play would really be Treasury Wine Estates. Really, if you have to choose one, but clearly that's not just it's agricultural of a sort. A tasty agricultural aspect, of course.
Right. But, Mr. Hermitage.
Indeed, right. Mr. Hermitage. But notwithstanding that, I think that, you know, the exposure like Elders, exposure like AACO have had a great period in terms of the cattle price. Had a great result from that, of course. But, you know, at the moment, these dry conditions would be worrying them.
Well, our next guest, is he more Hermitage or is he more Blue Nun? That is the question we'll be putting to Steve Keen when we go live to London. That's coming up after a short break. Stay with us.